Hey everyone, welcome back to the channel. Today I'm diving into one of the most significant financial events of the 21st century, the subprime mortgage crisis. If you're a finance enthusiast, you'll definitely want to stick around for this one. All right, let's set the scene. It's the early 2000s and the housing market is on fire. Home prices are skyrocketing and everyone wants a piece of the action. But here's the catch. Mortgages are being handed out like candy on Halloween, even to people with shaky credit histories. These are what we call subprime mortgages. Now you might be wondering, what's the big deal? Well, here's where things get interesting. Banks were packaging these risky loans into what are known as mortgage-backed securities and selling them to investors. Everyone thought it was a win-win situation. Homebuyers got their dream homes, banks made money, and investors got high returns. But, and this is a big but, the entire system was built on a shaky foundation. When interest rates started to rise and home prices began to fall, borrowers couldn't keep up with their mortgage payments. Defaults skyrocketed. Suddenly, those mortgage-backed securities weren't worth much and the house of cards came tumbling down. The impact was massive. Major financial institutions like Lehman Brothers collapsed and the global economy was thrown into chaos. Stock markets plummeted and millions of people lost their jobs and homes. Governments around the world had to step in with massive bailouts to stabilize the financial system. But here's the silver lining. The crisis led to significant changes in financial regulation. The Dodd-Frank Act was introduced in the United States to increase transparency and reduce risks in the financial system. It was a wake-up call that made investors and regulators more cautious about excessive risk-taking. So why should you care about all this? Understanding the subprime mortgage crisis helps us learn from past mistakes and build a more stable financial future. It's a reminder that what goes up can come down and the importance of sound financial practices. Thanks for watching. If you enjoyed this video, don't forget to like, subscribe, and hit that notification bell for more finance insights. Until next time, take care and stay savvy. To truly understand the subprime mortgage crisis, we need to delve deeper into the origins of the housing bubble. In the early 2000s, low interest rates and relaxed lending standards fueled a housing boom. People were eager to buy homes and banks were more than willing to lend. This created a perfect storm where demand for housing surged, driving prices higher and higher. As home prices soared, more people jumped into the market, fearing they would miss out on the opportunity to own a home. This frenzy was further fueled by speculative buying, where investors purchased homes not to live in, but to sell at a profit. The belief that home prices would continue to rise indefinitely led to risky financial behavior. Banks and mortgage lenders began offering subprime mortgages to borrowers with poor credit histories, believing that rising home prices would cover any potential losses. These subprime mortgages were then bundled into mortgage-backed securities and sold to investors, spreading the risk throughout the financial system. Initially, this seemed like a win-win situation. Home buyers got their homes, banks made profits, and investors enjoyed high returns. However, the underlying risks were largely ignored. The assumption that home prices would always rise proved to be a dangerous fallacy. As interest rates began to rise, the cost of borrowing increased, making it harder for borrowers to keep up with their mortgage payments. Defaults on subprime mortgages started to climb and the once booming housing market began to cool. As home prices fell, the value of mortgage-backed securities plummeted, causing massive losses for investors. The ripple effects were felt throughout the financial system, leading to a credit crunch and a severe economic downturn. Major financial institutions heavily invested in mortgage-backed securities faced insolvency. Lehman Brothers, one of the largest investment banks, declared bankruptcy. The crisis prompted unprecedented government intervention with massive bailouts and stimulus packages aimed at stabilizing the financial system. The aftermath of the crisis led to a re-evaluation of financial regulations and practices. The Dodd-Frank Act, introduced in 2010, aimed to increase transparency, reduce risks, and prevent future financial crises. The Act introduced stricter oversight of financial institutions, requiring them to maintain higher capital reserves and undergo regular stress tests. It also established the Consumer Financial Protection Bureau to protect consumers from predatory lending practices. While the Dodd-Frank Act has faced criticism and calls for reform, it represents a significant step towards a more stable financial system. The subprime mortgage crisis serves as a stark reminder of the dangers of excessive risk-taking and the importance of sound financial practices. By learning from past mistakes, we can build a more resilient and stable financial future. It's crucial to stay informed and make prudent financial decisions to avoid repeating the mistakes of the past. If you enjoyed this video, don't forget to like, subscribe, and hit that notification bell for more finance insights. Until next time, take care and stay savvy.